There is a document that Wall Street institutions, hedge funds, and private equity firms pay hundreds of thousands, sometimes millions of dollars to replicate. They hire armies of the brightest minds from the best schools, arm them with supercomputers, and task them with creating a mosaic of information that will give them a fractional edge in the market. They are trying to build a perfect, unadulterated picture of a business, its strengths, its hidden weaknesses, its true trajectory. They believe that with enough data, enough processing power, they can manufacture this document. And yet, this document already exists. It is published for free once a year by every publicly traded company in America. It's called the annual report. And while the rest of the financial world is busy building complex models to approximate its truth, one man simply sits down in his office in Omaha, Nebraska, pours himself a cherry Coke, and reads it. He reads it not like an analyst, but like a novelist. He reads it to find the plot, to understand the characters, to hear the author's true voice. This one simple habit, this one deviation from the frenetic noise of the market, is arguably the single greatest source of the informational advantage that made Warren Buffett one of the wealthiest people in human history. He is not consuming information that has been filtered, interpreted, spun, and sold by the Wall Street machine. He is going directly to the source. And in doing so, he bypasses the most costly mistake any investor can make: outsourcing their own thinking. He prevents himself from falling victim to the biased, superficial, and often dangerously wrong analysis that masquerades as financial news. What you are about to learn is not a stock tip. It is a fundamental rewiring of how you consume financial information. It is the process of transforming a document that 99% of investors find intimidating and boring into a thrilling detective novel, a story where the clues, if you know how to spot them, lead to incredible financial opportunity. This is the skill of finding the story in the numbers, the truth in the management's discussion, and the red flags in the footnotes. This is how you gain an edge that no algorithm can replicate. This is how you learn to read the one financial document that truly matters. Our journey into this world begins not with a number but with a philosophy. A foundational belief system that separates the amateur from the professional, the speculator from the business owner. It is the philosophy of the primary source. Why, in a world of infinite information, of instant news alerts and expert commentary, would a man with access to anything he desires choose to rely on a document that is often months old by the time it's released? The answer lies in understanding what information truly is and what it is not. The financial media sells headlines. Analysts sell recommendations. Brokers sell transactions. But an annual report sells nothing. Its legally mandated purpose is to inform the owner of a business about the state of their property. It is a letter from the people you have hired to manage your capital, explaining what they have done with it. To ignore this document in favor of a 5-minute segment on television is the equivalent of owning an apartment building and choosing to learn about its condition by reading graffiti on a bus stop bench 3 blocks away, instead of reading the detailed inspection report from your own building manager. The graffiti is more exciting, more current, but the inspection report is the truth. Buffett's entire career is a testament to the power of trusting the inspection report over the graffiti. There is no story that better illustrates this philosophy in action than a crisis that threatened to bring down one of America's most iconic financial institutions in the fall of 1963. The company was American Express. At the time, it wasn't just a credit card company. A huge and seemingly stable part of its business was in warehousing. Through a subsidiary, it would inspect a company's inventory, say barrels of oil in a tank, and issue a receipt for it. That receipt then became collateral, allowing the company to get loans from a bank. It was a simple, boring, profitable business, until it wasn't. A small, unassuming company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis, was a major client. DeAngelis had devised a brilliant scam. He would fill his massive storage tanks mostly with water, with only a thin layer of valuable salad oil floating on top. When the American Express inspectors came, they would measure the contents and, seeing oil, issue receipts for entire tanks full of it. De Angelis used these fraudulent receipts to secure over $150 million in loans, an astronomical sum at the time. When the fraud was uncovered, Allied crude vegetable oil collapsed instantly. The banks that held the receipts turned to American Express, demanding they make good on the collateral. Wall Street panicked. The narrative, the graffiti on the bus stop, was simple and terrifying. American Express was on the hook for a catastrophic $150 million, a sum that could potentially bankrupt the company. The stock, which had been trading at $60 a share, plummeted to $35 in a matter of days. Analysts downgraded it. The news screamed of insolvency, and investors, guided by this secondhand information, sold in a panic. This is where the story of the 99% ends. They heard the noise, they believed the story, and they sold their ownership in a great American company at the absolute worst time. But Warren Buffett's story was just beginning. He didn't turn on the television, he didn't read the analyst reports, he understood the philosophy of the primary source. In this case, since the annual report wouldn't reflect the crisis for months, he had to create his own primary source data. He asked himself a simple question: has this scandal actually affected the core underlying business of American Express? He wasn't interested in the legal liabilities, which he correctly assumed would be negotiated down over time. He was interested in the company's moat, its durable competitive advantage. Did people still trust the American Express brand? So he did something laughably simple. He went to the source. He walked into restaurants in Omaha. He visited travel agencies. He talked to bank tellers. He would see a patron pay with an American Express card and ask the waiter if they'd noticed any change. He'd ask merchants if they were still accepting the cards and travelers' checks with the same confidence as before. He became a one-man research team, collecting raw, unfiltered data from the people who actually used the product. What did he discover? Nothing. Absolutely nothing had changed. Customers were still using their cards. Merchants were still honoring them. The traveler's check business, the company's golden goose, was completely unaffected. The scandal, while a massive financial headache, had not pierced the armor of the brand in the minds of the consumers. The graffiti screamed bankruptcy, but the primary source data whispered that the fundamental business was not only intact, but was humming along just as it always had. Armed with this direct knowledge, Buffett began to act. Berkshire Hathaway started buying American Express stock aggressively. He invested 40% of his partnership's capital, a massive bet, buying up shares as the panic sellers fled. Over the next few years, as the company settled the legal claims for a fraction of the feared amount and the market realized the core business was a powerhouse, the stock soared. Buffett's investment more than tripled, netting his partnership a fortune. He didn't have a supercomputer, he didn't have an inside source, he had a philosophy, a belief in ignoring the processed, hysterical narrative of the crowd, and a commitment to getting his information, his story, directly from the primary source. The force that drove thousands of investors to sell their American Express stock at the bottom was not stupidity. It was a predictable, hardwired feature of the human brain. Buffett's method is so powerful because it acts as a direct countermeasure to some of our most potent cognitive biases. The first and most relevant is the narrative fallacy, a concept popularized by Nassim Nicholas Taleb. Our brains are not built to understand raw data. They are built to understand stories. We crave simple, coherent narratives to explain complex, random events. In the salad oil scandal, the story was easy. Scandal hits company. Company may go bankrupt. It's a clean, simple, and emotionally resonant plot. It's easy to remember and easy to spread. The reality, a complex web of legal liabilities, brand equity, consumer behavior, and discounted cash flows, is not a story. It's a messy spreadsheet. The human mind will choose the simple story over the messy spreadsheet every single time, even when the story is wrong. The financial news media exists almost entirely to create and perpetuate these simple narratives. Buffett, by forcing himself to go to the primary source, the annual report, or in this case, direct market research, is refusing to consume the prepackaged narrative. He is forcing his brain to confront the messy spreadsheet of reality, to build a story from the ground up based on facts, not on headlines. Closely related is the powerful effect of confirmation bias. Once an investor hears the narrative, American Express is in trouble, their brain subconsciously begins to look for evidence that confirms it and to ignore evidence that contradicts it. Every negative news article becomes proof. Every dip in the stock price becomes validation. A Wall Street analyst whose own reputation is on the line is intensely susceptible to this. They hear the negative story, and their research often becomes a hunt for data points to support the prevailing wisdom, lest they look foolish by being a lone bull. This creates a herd mentality, an echo chamber where a false narrative can become amplified until it is accepted as fact. Buffett's process is a systematic destruction of this echo chamber. By locking himself away with only the primary documents, he is starving his brain of confirmatory signals from the outside world. He is creating an environment where the only voice he can hear is the voice of the business itself, speaking through its numbers and its management's own words. He isn't trying to confirm what CNBC is saying. He is trying to discover the truth, regardless of what that truth may be. This intellectual isolation is not an accident. It is a crucial component of the strategy. It allows for the kind of clear, independent thought that is impossible when you are adrift in a sea of other people's opinions. He is building his mental model of the company brick by brick from the raw material of the annual report, rather than accepting the prefabricated and often flimsy structure built by the market's storytellers. So how can you, today, apply this same philosophical discipline to your own investment research and executive decision-making? The first step is to create what we will call the Circle of Competence Information Diet. It is a mental model designed to systematically eliminate second-hand noise and force a reliance on primary sources. It's a three-step process. Step 1 is the most important. You must brutally and honestly define your personal circle of competence. What industries do you genuinely understand? Not because you read an article about them, but because you've worked in them, you're a passionate customer, or you have a deep hobbyist-level knowledge of how they operate. It might be retail, consumer software, banking, or even something as niche as waste management. Be honest. Your list might only contain 1 or 2 industries. That is perfectly fine. A small circle, well defended, is infinitely more profitable than a vast, shallow sea of ignorance. Step 2 is the purge. For the next 30 days, you will systematically eliminate all sources of financial news and opinion related to the companies within your defined circle. Unfollow the pundits on social media. Cancel the subscriptions to the market newsletters. Set your television to any channel but the financial news networks. The goal is to create a total information vacuum. This will feel uncomfortable at first. You will feel out of the loop. This feeling is the addiction to low-quality information leaving your system. Step 3 is the immersion. Select one single company that sits squarely in the middle of your circle of competence. Go to its investor relations website and download its last 5 annual reports. Not 1 but 5. This gives you a sense of the narrative arc of the business. Then, you must make a promise to yourself. For the next month, these 5 documents, and these 5 documents alone, will constitute your entire universe of information about this company. That's it. No articles, no podcasts, no analyst ratings. Just you, the company's unfiltered story, and a quiet room. Your task is not to decide whether to buy the stock. Your task is simply to read these documents from cover to cover with the goal of answering one question: do I understand this business, its economics, and its management well enough that I could explain it to a 10-year-old? You will start with the CEO's letter, as we will discuss. You will move to the financial statements, and you will even dare to venture into the footnotes. You are not looking for a stock tip. You are training your mind to derive its own conclusions from primary evidence. You are breaking the addiction to second-hand thought. After 30 days of this focused immersion, you will find something remarkable has happened. You will understand that one business with more clarity and depth than you have ever understood any investment in your life. You will have built your opinion from the bedrock of fact, not from the shifting sands of market chatter. This is the first and most critical step toward making genuine, intelligent investor decisions. To truly appreciate the power of this approach, we must spend a moment examining its antithesis, the path that 99% of market participants tread, often to their own financial detriment. Let us call this archetype the CNBC investor. Their day begins not with a quiet cup of coffee and a well-structured document, but with a cacophony of bells, flashing lights, and urgent voices. The television is on before the market opens, a constant stream of expert predictions, price targets, and breaking news. The CNBC investor feels informed. They feel connected to the pulse of the market. They hear that a tech company has just beaten earnings expectations, and the stock is soaring in pre-market trading. An analyst comes on screen, breathlessly upgrading his recommendation to a strong buy. The ticker flashes green. The emotional pull is immense, a cocktail of greed and fear of missing out. What does the CNBC investor do? They log into their brokerage account and buy. They have made a significant capital allocation decision in a matter of minutes, based on 3 pieces of second-hand information: a headline earnings number, an analyst's opinion, and a price chart. They have not read the earnings press release, let alone the quarterly report. They do not know if the earnings beat was due to strong underlying business performance or a one-time asset sale. They do not know if the company's balance sheet is loaded with debt. They do not know if the company is generating any real cash. They have simply reacted to the stimulus, like Pavlov's dog salivating at the sound of a bell. A few weeks later, the narrative shifts. A competitor announces a new product. A negative article about the company's culture surfaces. The same analyst who recommended a strong buy now downgrades the stock to hold, citing macroeconomic headwinds. The stock price begins to fall. The ticker flashes red. The CNBC investor, who had no foundational understanding of the business to begin with, now feels the cold grip of fear. Their only anchor was the stock price, and that anchor is now dragging them down. They have no internal conviction, no knowledge of the company's intrinsic value to hold on to. All they have is the same external stimuli that prompted them to buy, which are now screaming for them to sell. So they sell, locking in a loss. They then blame their bad luck, the crooked market, or the lying analyst. They never realize that the true fault lies in their process. They outsourced their thinking, and they paid the price. They chose the graffiti over the inspection report. This cycle of chasing headlines, outsourcing due diligence, and making emotionally driven decisions based on incomplete, second-hand information is the single greatest destroyer of wealth for the retail investor. It is a game that is mathematically impossible to win over the long term because you are always playing with a massive information disadvantage against the house. The philosophy of the primary source is not just a better way, it is the only way to opt out of this rigged game and begin playing a different one. A game where you hold the informational edge. The direct financial connection between this philosophy and your bottom line is a concept we can call information arbitrage. In financial markets, arbitrage usually refers to exploiting price differences for the same asset in different markets. But information arbitrage is more subtle and more powerful. The vast majority of market participants, including many professionals, are all consuming the same processed information. They read the same major newspapers, watch the same financial channels, and subscribe to the same analyst reports. This creates a consensus reality, a shared story about a given company. The price of the stock, in the short term, largely reflects this consensus story. When you choose to ignore this entire ecosystem and derive your knowledge directly from the annual report, you are effectively operating in a different information market. You are not getting the story after it has been interpreted, simplified, and sensationalized. You are getting the raw data. This allows you to spot discrepancies between the popular narrative and the underlying reality of the business. This discrepancy is your opportunity for arbitrage. For example, The consensus story about a company might be that it is a boring, slow-growth business, and the stock price will reflect this. But in your deep dive of the annual reports, you might discover a small, rapidly growing new division that is buried in the segment data, one that the market has completely overlooked. You might see from the cash flow statement that while reported earnings are flat, the company is generating enormous amounts of free cash flow that it is using to buy back its undervalued shares, creating huge value for remaining shareholders. You now know something the market doesn't know, or at least doesn't appreciate. You have an informational edge. Your decision to buy is not based on a hot tip. It's based on a fundamental mismatch between the consensus reality and the reality you uncovered in the primary source. This edge doesn't last forever. Eventually, the market may catch on. The new division will become too big to ignore, and it will be the subject of a glowing headline. The powerful effects of the share buybacks will show up in earnings per share, and an analyst will upgrade the stock. But by then, you will have already established your position at a much lower price. The financial transformation comes from realizing that you don't beat the market by having a faster computer or a better algorithm. You beat the market by having a better thought process. The discipline of primary sourcing is the cornerstone of that process. It's how you move from being a price taker, accepting whatever narrative the market gives you, to a value creator, actively seeking out and profiting from the gaps between perception and reality. This is the foundation of all serious wealth management and the first principle of truly intelligent capital allocation. Once you have embraced the philosophy of the primary source, your journey into the annual report begins. And it begins not with the intimidating tables of numbers, but with the one part of the document that is pure, unadulterated narrative, the letter to the shareholders. This is often the first few pages, written and signed by the chief executive officer or the chairman. Most investors skip this section, believing it to be little more than corporate propaganda, a collection of glossy photos and self-congratulatory prose. This is a colossal mistake. For Warren Buffett, the shareholder letter is a microscope into the mind of management. It is a qualitative compass. The numbers tell you what a business has done. The letter, if you know how to read it, tells you what the people running the business are thinking. It reveals their character, their priorities, and their understanding of the business they are supposed to be stewarding on your behalf. To Buffett, investing is not just buying a piece of paper. It is entering into a long-term partnership with the people in the executive suite. The shareholder letter is your first and often most revealing job interview with your potential new partners. There is no better case study for this principle than Buffett's 1973 investment in the Washington Post Company. At the time, the market viewed newspaper companies as respectable but stodgy businesses. The Washington Post Company, however, was a collection of high-quality assets, including the flagship newspaper, Newsweek magazine, and several highly profitable television stations. The market, fixated on the newspaper, was undervaluing the entire enterprise. The whole company had a market valuation of about $80 million. Buffett, after doing his initial analysis, thought the business was worth at least $400 million, and likely more. It was a classic value investing opportunity. But the numbers alone were not enough. He needed to understand the people he would be entrusting with his capital. The company was controlled by the Graham family, specifically by Katharine Graham, who had taken over as publisher after the tragic death of her husband. She was, at the time, one of the only female leaders of a major American corporation, navigating a deeply male-dominated world. Buffett did what he always does. He began to read. He devoured every annual report the Washington Post Company had ever published. He paid special attention to the letters written by K. Graham. What he found was not the promotional fluff common in most corporate reports. He found a voice of extraordinary candor, intelligence, and integrity. She wrote with clarity and humility. She discussed the challenges facing the business as openly as she celebrated its successes. She wrote not as a promoter trying to boost the stock price, but as a steward of a public trust and a family legacy, communicating honestly with her fellow owners. He saw in her writing an owner-oriented mindset, a deep understanding of the economics of her businesses, and an unwavering commitment to quality journalism, which he recognized as the ultimate source of the company's competitive moat. His assessment of her character, derived almost entirely from her letters, was the final, critical piece of the puzzle. He knew that this was a person he could trust, a partner who would allocate capital intelligently and act in the best interests of long-term shareholders. In 1973, he invested over $10 million, a significant sum for Berkshire at the time, to acquire a large stake in the company. He joined the board, and his partnership with K. Graham became one of the most famous and successful in American business history. That $10 million investment, made on the back of both a quantitative valuation and a qualitative judgment of character, would grow to be worth over $1 billion. It was a testament to the power of using the shareholder letter not as a marketing brochure, but as a character reference for the most important employee you will ever hire, the CEO of the company you own. The reason Buffett's method of analyzing a CEO's letter is so effective is because it short-circuits another powerful set of psychological tendencies. The first is what psychologists call the fundamental attribution error. This is our tendency to attribute our own successes to our skill and our failures to bad luck, while doing the exact opposite for others. We see a successful person and think, they got lucky, but if they fail, we think, it was a flaw in their character. A great CEO letter, one written by a rational and honest leader, inverts this. Buffett looks for leaders who attribute the company's successes to the entire team, the strength of the business model, or even a bit of good fortune. This signals humility and a reality-based view of the world. Conversely, he looks for leaders who take direct, personal responsibility for failures. When a division performs poorly, the weak CEO blames a challenging macroeconomic environment or unforeseen market shifts. The strong CEO says, I made a mistake here. I misjudged the competitive landscape, and here is what I am doing to fix it. This is an incredibly powerful signal of what Buffett calls a rational manager. A rational manager deals with the world as it is, not as they wish it were. They are not afraid to admit error, because their ego is secondary to the success of the enterprise. This candor is not just a sign of good character. It is a prerequisite for good capital allocation. A CEO who cannot admit small mistakes is incapable of correcting large ones. The second psychological principle at play is the signaling of honesty and trustworthiness through language. The vast majority of corporate communication is filled with jargon, buzzwords, and what Buffett derisively calls the PR department's smoke. Phrases like synergistic value creation, leveraging core competencies, and optimizing strategic initiatives are red flags. They are designed to sound impressive while communicating almost nothing of substance. They are often used to obscure poor performance or a lack of clear strategy. A CEO who writes in simple, plain English, the same way they would talk to their partner at the dinner table, is signaling confidence and transparency. They are not hiding behind complexity. They believe the underlying business is strong enough to be described in simple terms. Think of the difference between a doctor who tells you the patient is experiencing a cardiopulmonary event and one who says your father is having a heart attack. Both are technically correct, but the second one communicates with clarity and honesty. Buffett is looking for the CEO who speaks like the second doctor. This clarity of language is a proxy for clarity of thought. A manager who cannot explain their business strategy in a few simple, jargon-free paragraphs probably doesn't have a clear strategy to begin with. By focusing on these subtle cues of candor, humility, and clarity, Buffett is conducting a deep psychological assessment of management's fitness to be a responsible steward of his capital. To translate this into a practical tool, you can use a mental model called the Owner's Test Checklist every time you read a letter to shareholders. It's a series of 5 questions you must ask yourself as you read. Put yourself in the shoes of someone who owns 100% of the business, and the CEO is your most important employee, reporting to you once a year through this letter. Question 1 is the candor check. Does the CEO openly and specifically discuss the company's problems and mistakes from the past year? Don't look for vague platitudes like "we faced some headwinds." Look for specifics. Our expansion into the European market was a failure. We underestimated the logistical challenges and have now written down that investment. That is candor. The more specific the admission of failure, the higher the score. Question 2 is the jargon filter. Take a highlighter and mark every instance of corporate jargon or overly complex language. If the page is covered in yellow by the end, it's a major red flag. Is the CEO explaining the business in a way your intelligent but non-expert cousin could understand? Or are they trying to dazzle you with vocabulary? Simplicity and clarity are signs of strength. Question 3 is the capital allocation litmus test. This is the most important. How does the CEO talk about the company's cash? Do they explain, talks why, talks they made the decisions they did? If they repurchase shares, did they explain that they did so because they believed the stock was trading below its intrinsic value? If they made a large acquisition, did they lay out the strategic rationale and the price they paid? Or do they just list the activities? A great manager will treat your capital with the same care they would their own, and they will be eager to explain their capital allocation decisions to you, their partner. Question 4 is the performance measurement standard. What benchmarks does the CEO use to judge their own performance? Do they compare this year's results to last year's, which can be easy if last year was terrible? Or do they compare their performance over a 5 or 10-year period against a tough, relevant competitor or a market index? Honest managers set a high bar for themselves and are not afraid to be measured against it. Self-serving managers cherry-pick flattering, short-term comparisons. Finally, question 5 is the "if I were on the other side" test. As you read the letter, imagine you are the CEO of their fiercest competitor. What in this letter would scare you? Is it the company's fanatical focus on low costs, its obsession with customer service, its brilliant capital allocation strategy? If you read the whole letter and, as a competitor, you feel no sense of fear or envy, it is likely the company has no significant competitive advantage. Using this 5-point checklist transforms the shareholder letter from a passive reading exercise into an active, critical analysis of your potential business partners. The antithesis to this disciplined approach is what ensnares the vast majority of investors: the seduction of the visionary CEO. This is the charismatic, media-savvy leader who paints a grand, sweeping picture of the future. They talk about changing the world, disrupting industries, and creating new paradigms. Their letters and interviews are filled with exciting narratives and bold proclamations. They are masters of storytelling, and the market loves them. Investors, drawn to the power of a compelling story, flock to these companies, often bidding their stock prices up to astronomical levels that have no connection to the underlying financial reality. The case of WeWork and its founder Adam Neumann is a textbook example. Neumann was a brilliant storyteller. He didn't talk about renting office space. He spoke of elevating the world's consciousness. The company's mission wasn't to sublet desks, it was to create a global community. He was a visionary, and investors, including some of the most sophisticated private equity and venture capital firms in the world, were utterly captivated. They poured billions of dollars into the company based on this narrative. Anyone who applied the owner's test checklist to WeWork's communications would have seen a sea of red flags. The candor check? There was no discussion of the company's staggering and growing losses. It was all hockey stick projections of a glorious future. The jargon filter? The company's filings were a masterclass in obfuscation, with made-up metrics like community-adjusted EBITDA, designed to hide the fact that the core business was hemorrhaging cash. The capital allocation litmus test. Billions of dollars were being spent not on prudent, value-creating investments, but on lavish parties, corporate jets, and ill-advised acquisitions that had no strategic logic. The entire enterprise was a story, a vision, completely detached from the principles of sound business and rational capital allocation. The 99% who were seduced by the narrative and ignored the underlying fundamentals suffered catastrophic losses when the story inevitably fell apart. They were not investing in a business. They were buying a ticket to a story that the visionary CEO was selling. Buffett's approach is the antidote to this. He is intentionally deaf to the siren song of the visionary. He is interested not in the story of what the business could be in a utopian future, but in the honest, candid assessment of what the business key is today, as told by a rational, trustworthy partner in the CEO's chair. The direct financial connection here is powerful and twofold: the reduction of agency risk and the enabling of compounding quality. Agency risk is a term from economics that describes the conflict of interest inherent when you hire someone, an agent, to manage something for you, the principal. In investing, the CEO is your agent. Agency risk is the risk that your CEO will act in their own best interest, to maximize their own salary, bonus, and prestige, rather than in your best interest as a shareholder. A CEO might overpay for a massive acquisition because it strokes their ego and creates a larger empire for them to rule, even if it destroys shareholder value. A CEO might use corporate funds for personal luxuries. They might manipulate accounting numbers to hit a short-term bonus target, even if it harms the long-term health of the business. The owner's test checklist is, at its core, a tool for assessing and minimizing agency risk. A candid, humble, clear-thinking CEO who is obsessed with rational capital allocation is far less likely to fall prey to these self-serving behaviors. By selecting for these traits, you are dramatically increasing the odds that the person managing your capital will treat it with the respect it deserves. This, in turn, leads to the magic of compounding quality. A company's long-term value is not created by one brilliant move, but by a series of thousands of small, intelligent decisions made over decades. The most important of these decisions is how to allocate the cash the business generates. Should it be reinvested into the core business, used to acquire a competitor, returned to shareholders via dividends or buybacks? A business run by a rational, shareholder-oriented CEO will consistently make better capital allocation decisions year after year than a business run by a self-serving or irrational one. This small edge in decision-making quality, when compounded over 10, 20, or 30 years, creates a staggering difference in the ultimate financial outcome. It's the difference between a business that plods along and one that becomes a true compounding machine, generating immense wealth for its long-term owners. Your ability to judge the character and thinking of management through the shareholder letter is therefore not a soft skill. It is one of the most potent financial tools you can possess. It is how you identify the management teams that will act as true partners in wealth creation, creating a powerful, long-term tailwind for your investment portfolio and your journey toward financial freedom. After assessing the character of the management, our detective story moves from the realm of the qualitative to the quantitative. We must now turn our attention to the heart of the annual report, the three core financial statements. For most people, this is where the eyes glaze over. The income statement, the balance sheet, and the cash flow statement appear to be nothing more than a dense grid of numbers and arcane accounting terms. It feels like a foreign language. But this is a profound misunderstanding. These are not just tables of data, they are chapters in a story. They are the narrative of the business, told in the universal language of money. Buffett's genius is his ability to read these statements not as an accountant, but as a business analyst, piecing together the plot, understanding the characters, and discovering the truth of the company's journey. He is not just crunching numbers, he is discerning the story that the numbers are telling. To learn to read financial statements is to learn to read the biography of a business. A perfect illustration of this principle is one of Buffett's most celebrated acquisitions, See's Candies, in 1972. On the surface, it was a simple family-owned chain of candy shops on the West Coast. The sellers wanted $30 million for it. To many on Wall Street, it would have looked like a boring, old economy business with limited growth prospects. But Buffett and his partner, Charlie Munger, didn't see a boring business. They saw a beautiful story being told by the financial statements. When they looked at the income statement, they saw the first part of the plot: consistent, growing profitability. Year after year, the company sold more candy at higher prices, and the profits flowed steadily. More importantly, they saw high profit margins, which told them that customers were not buying See's Candy because it was cheap. They were buying it because they loved the brand and associated it with quality and nostalgia. This was the sign of a powerful moat. Then they turned to the balance sheet. They saw a story of incredible capital efficiency. The business required almost no capital to operate. Customers paid in cash up front for the candy, but See's paid its suppliers for sugar and chocolate on terms, maybe 30 or 60 days later. This created a, quote, where the customer's money could be used to fund operations. The company didn't need to tie up huge amounts of money in inventory or receivables. The balance sheet story was one of a business that gushed cash without requiring much investment. The final chapter, the cash flow statement, confirmed it all. The business generated far more cash than it needed to maintain its operations. It was an economic machine that produced a river of cash for its owners. The numbers told a coherent and powerful story. This was not just a candy company, it was a royalty on customers, affection, a business with a deep competitive advantage that required very little capital to grow. They saw that the brand was an unlisted asset on the balance sheet with immense value. Based on this story, they agreed to pay the asking price, which seemed high to others. Over the decades, See's Candies has generated over $2 billion in cash for Berkshire Hathaway, all while requiring minimal additional investment. It was a phenomenal success, born not from a complex algorithm, but from the ability to read the simple story told by a simple set of financial statements. The psychological trap that Buffett's narrative approach to numbers helps him avoid is a 1-2 punch of anchoring and the availability heuristic. Most investors begin their research process by looking at the stock price. That number becomes an anchor in their mind. If the stock is trading at $100, their subsequent analysis is subconsciously framed around justifying that $100 price. They then look for information that is easily available, a recent news headline, a quarterly earnings report, to support their view. The availability heuristic is our mental shortcut of relying on immediate examples that come to mind when evaluating a topic. A positive news story makes us feel positive about the company's prospects. Buffett systematically inverts this process. He often claims to read an entire annual report without knowing the company's stock price. He wants to read the story of the business, the plot from the income statement, the character profiles from the balance sheet, the unfiltered truth from the cash flow statement, and form his own opinion of what the entire business is worth first. He is building his valuation from the ground up, based on the fundamental economic reality of the company. Only after he has a number in his head, his estimate of intrinsic value, will he look at the stock price. This simple reversal is a profound psychological hack. It prevents the market's current mood, as reflected in the stock price, from influencing his objective analysis of the business itself. He is not asking, is this $100 stock a good buy? He is asking, what is this business worth? And then, how does that compare to the $100 price the market is offering? By focusing on the story within the statements, he anchors his mind to the fundamental reality of the business, not the ephemeral opinion of the market. He is making his decisions based on the deep, slow-moving currents of business value, not the noisy, chaotic waves of stock prices. To make this intimidating process accessible, you can use a mental model called the 3-chapter novel technique. This framework turns the financial statements into a coherent narrative that anyone can understand. Chapter 1 is the income statement, and its theme is the plot. The income statement tells you the story of the company's performance over a period of time, usually a year or a quarter. The very first line, revenue, is the beginning of the story. How much did the hero sell? You want to look at the revenue line over the past 5 to 10 years. Is the plot thickening? Is revenue consistently growing, stagnant, or declining? The next key character is gross margin, which is revenue minus the direct cost of goods sold. Is the protagonist an efficient operator? A consistently high and stable gross margin suggests the company has pricing power and a strong competitive advantage. The final line, net income, is the happily ever after of the chapter. After all expenses, taxes, and costs, how much profit was left for the owners? Just like in a novel, you're looking for a consistent and compelling plot of growing revenues, stable margins, and rising profits. Chapter 2 is the balance sheet, which tells the story of the characters and the setting at a single point in time. It's a snapshot. On one side you have the assets, what the company owns. Is the main character strong and well-equipped? Look for a healthy amount of cash and assets that genuinely generate income. On the other side, you have liabilities and equity, what the company owes and what the owner's stake is. Is the hero weighed down by burdens? Look at the level of debt. High levels of debt relative to equity can turn a small problem into a fatal one. The balance sheet tells you whether the protagonist of your story is a debt-laden weakling or a financially powerful hero ready for the next adventure. Chapter 3 is the cash flow statement, and its theme is the unfiltered truth. If the income statement is what the company tells the world, the cash flow statement is its private diary. It shows where the cash actually came from and where it actually went. It's broken into 3 parts: cash from operations, investing, and financing. The most important line in all of finance is in this chapter: free cash flow. This is the cash generated from the core business operations minus the capital expenditures needed to maintain it. This is the pot of gold at the end of the story. This is the real, spendable cash that the business generates for its owners. A company that consistently produces strong free cash flow is the hero that wins in the end. By reading the statements in this narrative order: plot, characters, and unfiltered truth, you transform a jumble of numbers into a living story about a business's health, strength, and profitability. This is the foundation of all serious fundamental analysis. The path of the 99% is a stark contrast to this holistic, narrative approach. The most common mistake is the obsession with a single metric, most often earnings per share, or EPS. The financial news reports on it breathlessly every quarter. Company X beats EPS estimates by 2 cents, or Company Y misses EPS estimates, stock plunges. Investors are conditioned to believe that this single number is the be-all and end-all of a company's performance. But EPS, which comes from the income statement, is an accounting opinion, not a hard fact. It can be legally and easily manipulated through a variety of accounting tricks. A company can boost its EPS by changing how it depreciates its assets, by recognizing revenue more aggressively, or by buying back its own stock. Focusing only on this one number is like reading the last page of a book and thinking you understand the entire story. A classic real-world example of this folly was the wave of retail bankruptcies in the 2000s and 2010s. Many of these companies, like Linens, N-Things, or Circuit City, were reporting growing revenues and positive EPS for years. Investors who only looked at the income statement thought things were fine. But had they read the rest of the story, they would have seen a tragedy unfolding. The balance sheets showed debt piling up to dangerous levels to fund the expansion. And the cash flow statements, the unfiltered truth, revealed that these companies were burning through cash. They were not generating any real economic profit. The positive EPS was a mirage created by accounting conventions, while the businesses themselves were bleeding to death. The investors who were obsessed with the single metric of EPS were wiped out. Those who took the time to read the full 3-chapter novel saw the tragic ending coming years in advance. This is the critical difference between being a headline chaser and a true business analyst, and it is a core lesson in financial education for any serious retail investor or entrepreneur. The direct financial connection of this narrative approach is that it allows you to accurately value the company's economic engine. A business is, at its core, a machine for generating cash. Your job as an investor is to figure out how much that machine is worth. By reading the story in the numbers, you move beyond superficial metrics and begin to understand the true, underlying cash-generating power of the business. The free cash flow number you uncover in the 3rd chapter of your novel is the most important output of this engine. Once you have a confident grasp of a company's durable, normalized free cash flow, you can perform evaluation. The most common method, a discounted cash flow (DCF) analysis, is simply an attempt to calculate the present value of all the cash that the economic engine will likely produce for its owners in the future. This process transforms you from a speculator into a proprietor. You are no longer gambling on which way a stock price will wiggle tomorrow. You are making a calculated, business-like decision to buy a stream of future cash flows at a sensible price. You have a number, an estimate of intrinsic value, that is anchored in the economic reality of the business. This number becomes your North Star. If the market is offering to sell you the business for a price significantly below your calculated intrinsic value, you can buy with confidence. If the market price is far above your estimate, you can avoid it or sell, regardless of how popular the stock is or what the pundits are saying. This skill, the ability to read the financial story and translate it into a rational valuation, is the ultimate financial advantage. It is how you move from playing the market's game to playing your own. It is the core discipline of stock picking and the only reliable path to beating the market over the long term. It is the engine of all successful investment research. If the shareholder letter is the interview with management and the financial statements are the biography of the business, then the footnotes are the detective's private investigation file. They are tucked away at the very end of the annual report, a dense wall of tiny text and legalistic language. This is by design. This is where companies are legally obligated to disclose the details, assumptions, and potential problems that they would rather you not focus on. It is precisely for this reason that Buffett and other serious investors consider the footnotes to be one of the most important sections of the entire document. 99% of investors never read them. They are boring, they are complicated, and they require effort. But it is in this deliberate act of doing the hard work that others won't, that a true informational edge is forged. The footnotes are where the company explains how it arrived at the numbers you see in the main statements. They are where the secrets are buried, where the quality of the reported earnings is revealed, and where the biggest risks are often hiding in plain sight. Learning to read the footnotes is like being a detective who has just been given the key to the evidence locker. A powerful, if complex, example from Buffett's own world relates to the very core of Berkshire Hathaway, the insurance business. On the surface, an insurance company's financials can look deceptively simple, but the real story is always in the footnotes. A critical section in any insurance company's annual report details how it calculates its reserves for losses. This is the money the company sets aside to pay future claims. This number is not a fact. It is an estimate, an educated guess about the future. A conservative company will set aside ample reserves, ensuring it can meet its promises. An aggressive or desperate company might under-reserve, making its current profitability look much better than it actually is, but setting itself up for a future disaster. Buffett became a master at reading the footnotes related to reserving policies, particularly for complex, long-tail risks like asbestos liability. He could discern from the language and the actuarial assumptions whether a company was being realistic and conservative or reckless and promotional. This understanding was absolutely critical before his acquisition of companies like General Re. The headline numbers on the income statement were almost meaningless without first conducting a deep, forensic analysis of the reserving policies detailed in the footnotes. It was this granular, tedious work, the work no one else wanted to do, that gave him the confidence to make multi-billion-dollar decisions in the insurance industry. He knew where the bodies were buried because he was one of the few people willing to bring a shovel and dig in the footnotes. For any investor, this principle holds true. The quality of a company's earnings is only as good as the quality of the accounting assumptions disclosed in the fine print. The psychological principle that makes the footnotes such fertile ground for discovery is a phenomenon known as inattentional blindness. This is a fascinating quirk of human perception, famously demonstrated in an experiment where people were asked to watch a video of a basketball game and count the number of passes made by one team. During the video, a person in a gorilla suit walks into the middle of the game, beats their chest, and walks off. A stunningly high percentage of people, when asked afterward, will report that they did not see the gorilla. Their intense focus on the primary task, counting the passes, made them literally blind to a major, unexpected event happening in plain sight. The annual report functions in much the same way. Investors are conditioned to focus on the big, bold numbers: revenue, EPS, net income. These are the passes they have been told to count. The footnotes are the gorilla. They are present, they are significant, but because they are not part of the primary task the average investor has set for themselves, they are often completely ignored. Their brain filters them out as irrelevant noise. Buffett and other deep-dive investors intentionally train themselves to fight this tendency. They make looking for the gorilla their primary task. They know that the most critical piece of information is often not in the headline numbers, but in the qualifying details that everyone else is programmed to ignore. This conscious allocation of attention to the boring, difficult parts of a document is a deliberate strategy to counteract a natural human cognitive flaw. It is a form of mental discipline that yields enormous dividends because it allows you to see what is hidden from the undisciplined eye. To systematize your own detective work, you can use a mental model called the Financial Detective's Hot List. This is a checklist of the 6 most common places where companies hide important information in the footnotes. When you get to this section of the annual report, you should actively hunt for these specific items. Number 1. Revenue recognition. This footnote explains exactly when the company books a sale. Is it when the cash is received? When the product is shipped? Some companies use aggressive policies to book revenue far in advance of actually earning it, which can make growth look much stronger than it is. This is a critical first stop. Number 2. Debt covenants. If the company has loans, this footnote will detail the terms. Often there are covenants or conditions that the company must meet, such as maintaining a certain level of profitability. If the company is close to violating a covenant, it could be forced into bankruptcy or have to issue expensive new stock. This is where you find out how close to the edge the company is flying. Number 3. Leases and other off-balance sheet obligations. Many companies have massive liabilities that don't appear on the main balance sheet, most commonly long-term leases for their stores or offices. This footnote quantifies those promises, which can often be as significant as the official debt listed on the balance sheet. Number 4. Legal contingencies. This is where the company is required to disclose any significant pending lawsuits. A potentially catastrophic lawsuit might be mentioned only in a short paragraph here, but it could completely wipe out the company's equity if the verdict goes the wrong way. Number 5. Executive compensation. This section details exactly how the top managers are paid. Is their bonus tied to short-term EPS, which might incentivize them to manipulate the numbers? Or is it tied to long-term returns on capital, which aligns their interests with yours as a long-term owner? The compensation plan reveals the true priorities of the board. Number 6. Related party transactions. This is a classic red flag. This footnote discloses any business the company has done with its own executives, board members, or their families. If you see the company is buying its supplies from the CEO's brother-in-law's firm, it warrants extreme skepticism. Actively hunting for these 6 items will guide your attention to the most likely places to find the hidden gorillas in the financial statements. This is the essence of real due diligence. The antithesis of this deep forensic analysis is the glossy pages investor. This individual receives the annual report in the mail or downloads the PDF and is immediately drawn to the first few pages. These pages are filled with beautiful, high-resolution photographs of happy employees and satisfied customers. The text is marketing copy, written to inspire confidence and excitement. The glossy pages investor reads this section, feels good about the company, and then flips to the summary financial highlights. They see that revenue is up and earnings are positive. They might even read the CEO's optimistic letter, and then they stop. They have mistaken the advertising brochure for the full inspection report. To them, the footnotes are an intimidating and unnecessary appendix. The most catastrophic example of this failure in modern history is, of course, the Enron scandal. Enron's annual reports in the late 1990s were beautiful productions. They told a story of a revolutionary new economy company that was growing at an incredible pace. The glossy pages were filled with visions of a future dominated by Enron's trading platforms. The headline numbers looked spectacular. Most investors, including many seasoned professionals, stopped there. But the secret to Enron's entire fraud was hiding in plain sight, in the footnotes. In a section on related party transactions, Enron disclosed the existence of thousands of special purpose entities, or SPEs. These were complex legal structures that Enron was using to hide its massive debts and inflate its earnings. The footnotes were nearly impossible to understand, a deliberate act of obfuscation. But the very existence of these convoluted disclosures was a giant red flag. The few analysts and investors who took the time to dig into them and ask, "What is this, and why is it so complicated?" were the ones who saw the house of cards for what it was. The glossy pages investors, the 99%, who never ventured beyond the marketing material, were financially annihilated when the truth came out. It stands as the ultimate, brutal lesson on the catastrophic cost of ignoring the fine print. The direct financial connection between reading footnotes and your investment returns is the proper quantification of risk and the calculation of a true margin of safety. Investing is not just about estimating how much a company can earn, it is also about understanding what can go wrong. The footnotes are your primary tool for quantifying risk. When you uncover an aggressive revenue recognition policy, you must mentally adjust the company's reported earnings downward to be more conservative. When you find a large, undisclosed lease liability, you must add it to the company's total debt to get a true picture of its financial leverage. When you read about a major lawsuit, you must try to estimate the potential cost and subtract it from your valuation of the company. Each piece of negative information you uncover in the footnotes should serve to lower your estimate of the company's intrinsic value. This process is absolutely critical for establishing a margin of safety, the foundational concept of Benjamin Graham's value investing philosophy. A margin of safety is the difference between your conservative estimate of a company's intrinsic value and the price at which you are willing to buy its stock. You cannot have a true margin of safety if your estimate of intrinsic value is based on flawed, overly optimistic headline numbers. The detective work you do in the footnotes is what allows you to build a robust, conservative, and reality-based valuation. It's the difference between thinking a business is worth $100 per share and, after uncovering hidden risks, realizing it's actually worth only $60. If the stock is trading at $70, the glossy pages investor thinks they're getting a bargain. You, the financial detective, know it's still overpriced and dangerous. This ability to see the risks that others miss is what protects your capital from permanent loss and allows you to invest with genuine, well-founded confidence. It is the hallmark of the intelligent investor. We have now reached the final stage of our journey. We have embraced the philosophy of the primary source. We have interviewed management by dissecting the shareholder letter. We have read the biography of the business and its financial statements. And we have conducted our own private investigation in the footnotes. The final act is to synthesize all of this information into a single coherent narrative and, ultimately, into a decision. This is the moment where analysis must translate into action. It is the culmination of all the previous steps, transforming a mountain of data into the simple, powerful conviction required to allocate capital. It is not enough to do the research. You must be able to weave the qualitative and quantitative threads together to form a complete mosaic of the business, and then have the courage to act on your conclusion. This is the step that separates the academic from the practitioner, the analyst from the investor. The quintessential example of this synthesis is Buffett's historic 1988 investment in the Coca-Cola Company. For years, Buffett had read Coke's annual reports, admiring it from afar. He saw the qualitative story first, eloquently told in the company's communications. It was a story of a simple, wonderful product with a brand that was an untouchable piece of real estate in the minds of billions of people around the globe. This was the moat. He then saw the quantitative story in the financial statements, a narrative of breathtakingly high profit margins, minimal capital requirements, and a consistently growing river of free cash flow. This was the economic engine. He dug into the footnotes and found a clean, conservative business with no hidden skeletons in the closet. He had a complete picture of a truly phenomenal enterprise. But for years, the price was too high. The market knew it was a great business and valued it accordingly. Then came the stock market crash of October 1987. In the ensuing panic, the market sold everything, indiscriminately. The price of Coca-Cola stock, along with everything else, fell significantly. This was the opportunity Buffett had been waiting for. The crash had done nothing to change the taste of a Coke, the power of its brand, or the profitability of its business. The story he had pieced together from the annual reports was still true. The intrinsic value of the business was unchanged. Only the stock price, the sticker price offered by a manic depressive Mr. Market, had fallen. It was the synthesis of his deep business analysis with a clear-eyed understanding of market psychology that gave him the conviction to act. While others were panicking, Buffett calmly invested over $1 billion, buying a huge chunk of one of the world's greatest businesses at a rare bargain price. That decision, the culmination of years of reading and waiting, would become one of the most successful investments of all time, generating tens of billions of dollars in value for Berkshire shareholders. It was a masterclass in combining rigorous business analysis with decisive action. Even after completing this level of exhaustive research, the final step, pulling the trigger, is often the most psychologically difficult. This is where two final, powerful biases can sabotage even the most diligent investor. The first is the availability cascade. Once you have a conviction that a stock is cheap, you will suddenly notice a flood of information that seems to contradict you. The news will be negative. Pundits will be pessimistic. The stock price itself will likely be falling, a constant visceral signal that your conclusion is wrong. This creates a self-reinforcing cycle of negative information that can shake the confidence of even the most rational mind. The second is omission bias. Our brains are wired such that the pain of a loss from an action we took, a commission, feels much worse than the pain of a loss from something we failed to do, an omission. This makes it feel psychologically safer to do nothing. It's easier to miss out on a great opportunity than it is to buy a stock and watch it go down another 10% before it turns around. Buffett's antidote to these paralyzing forces is the very depth of the research process itself. The exhaustive, multifaceted analysis he performs is not just for information gathering, it is for building what can be called a conviction shield. His certainty is not based on ego or stubbornness. It is forged in the fires of due diligence. He has read the letters, he knows the numbers, he has scoured the footnotes. He understands the business better than the sellers who are panicking out of it. This deep, earned conviction acts as a psychological shield, allowing him to remain rational and act decisively when everyone else is paralyzed by fear or swept up in a cascade of negative sentiment. To build your own conviction shield and make the final decision, you can use a powerful mental model called the one-page investment thesis. After you have completed all your research on a company, you must be able to distill the entire argument for buying it onto a single sheet of paper. If you cannot explain it simply, you do not understand it well enough to risk your capital. This one-page thesis must contain 5 specific elements. First, the business in one sentence. You must describe what the company does in language so simple a child could understand it. For example, Coca-Cola sells branded colored sugar water to people all over the world. This forces clarity. Second, the economic moat. In a few bullet points, explain precisely why the business has a durable, competitive advantage. Is it a powerful brand? A low-cost production process? A network effect? Be specific. Third, the 3 key financial drivers. You've looked at hundreds of numbers. Which 3 matter most? For a retailer, it might be same-store sales, inventory turnover, and gross margin. For a software company, it might be customer acquisition cost, churn rate, and lifetime value. Identifying the critical few focuses your analysis. Fourth, the primary risk. What is the single biggest thing that could permanently impair the value of this business? This should come directly from your detective work in the footnotes, or your analysis of the competitive landscape. Acknowledging the primary risk proves you are not drinking your own Kool-Aid. Fifth, and finally, the valuation. State clearly what you believe the business is worth on a per-share basis. and what price you are willing to pay for it to ensure a sufficient margin of safety. This entire exercise, forcing your sprawling research into this concise, structured format, is the ultimate test of your understanding. If your one-page thesis is clear, logical, and compelling, you have earned the right to invest. This is the pinnacle of executive decision-making. The path of the 99%, even for those who attempt to do research, often ends in one of two failure modes. The first is analysis paralysis. This is the individual who becomes a professional student of a company. They read every report, build incredibly complex financial models, and can recite obscure facts from footnotes. But they are so terrified of being wrong, so caught up in analyzing every possible variable, that they never develop the conviction to actually buy anything. Their research becomes an end in itself, a form of intellectual entertainment, rather than a means to a financial end. The second failure mode is its ugly cousin, diversification. This is the investor who, lacking the deep conviction that comes from focused research, decides to hedge their bets by buying a little bit of everything. They own 50 or 100 different stocks, hoping that a few winners will offset the losers. In reality, they have built a portfolio that is guaranteed to produce mediocre, index-like returns, but with far more effort and transaction costs. As Buffett has famously said, wide diversification is only required when investors do not understand what they are doing. Both of these paths are a result of a flawed process that fails to produce genuine conviction. The goal of the rigorous multi-stage analysis we have discussed is not to be right about everything, but to be deeply, fundamentally, and unshakably right about a few things. This leads us to the ultimate financial connection, the power of a high-conviction, concentrated portfolio. The entire purpose of this exhaustive, time-consuming process is not to find 50 decent investment ideas. It is to find 2 or 3 truly exceptional ones per year. A business that is run by honest and intelligent management, that tells a beautiful story through its financial statements, that has no skeletons in its closet, and that is available at a price that offers a significant margin of safety. When you find one of these rare opportunities, the logical course of action is not to take a small, timid position. It is to bet big. This is how true wealth is built, not by spreading your capital thinly across dozens of mediocre ideas, but by concentrating it in a small number of businesses that you have come to understand with profound clarity. This approach is often criticized as being too risky, but the source of risk is not concentration, it is ignorance. Owning one business you understand completely is far less risky than owning 50 that you barely know. The deep dive research process is your primary tool for risk mitigation. By doing the work, you are earning the right to concentrate your capital. This is the fundamental shift from being a passive retail investor to an active, engaged business owner who uses the stock market as a venue to acquire pieces of wonderful companies at attractive prices. It is a transformation in mindset that, when executed with discipline, can be the engine that drives you from financial insecurity to genuine, lasting financial freedom. You have just been handed the master key. This entire system, this process of deconstructing an annual report from a philosophical foundation to a final synthesized decision, is a repeatable framework for gaining a genuine informational advantage in any field. You now possess the mental tool to unlock the true story of any business, to see through the noise of the market, and to identify value where others only see complexity. You have learned to interview the character of management, to read the narrative in the numbers, to uncover the secrets in the fine print, and to build the unshakable conviction that is the prerequisite for all great investment decisions. This is a rare and powerful skill, but understanding the story of the business is only the first half of the equation. A great business bought at a bad price is still a bad investment. The second, and arguably more critical half, is determining the price. What is the precise number a business is worth? How do you take the river of free cash flow you've uncovered and translate that into a single, hard number for its intrinsic value? How do you calculate that number with the same rigor Buffett does, creating a margin of safety that makes your investments virtually immune to the market's madness. The analysis you have just mastered tells you times what to buy. The next step is learning precisely when to buy it. The video that is now appearing on your screen is the missing link. It is the bridge that connects everything you have just learned about business analysis to the final, critical act of valuation. It takes the story you have learned to decode and translates it into that single powerful number. It is the essential next piece of the map, the link that transforms your deep understanding into profitable action. Most people will stop here, content with the knowledge they've gained. They will feel smarter, but their results will not change. But the few who are serious, those who are truly committed to building their mental arsenal and achieving financial freedom, will understand that this is a crucial and non-negotiable next step. The click you are about to make is not about watching another video. It is a decision to complete your training, to move from being an analyst to becoming a capital allocator. The choice, as always, is yours.